If you're 30 years old with 10 lakh rupees in an FD, you've been told you're on the right track. But have you done the math for 2045? At the rate the world is moving, is your safe 7% return going to buy you a retirement? Or is it just going to buy you a front row seat to a financial crisis you can't afford? Okay, real talk. You have 10 lakh rupees sitting in your bank account right now. Maybe it took you 3 years to save it, maybe it was a bonus, maybe you sold something. Doesn't matter how it got there. The point is, it's there. And every single day, you're staring at it thinking, this should be doing something, this should be growing. How do other people turn this into a crore? And then someone, your dad, your CA uncle, your colleague, goes, Arey, put it in an FD, safe hai, guaranteed return. So you do, and 5 years pass, and your 10 lakh rupees is now 14 lakh rupees. You feel okay about it. You feel like you made money. But here's what nobody told you. You actually got poorer. What's up, everyone? I'm Rohan, and I spend way too much time thinking about why smart, hardworking people stay stuck at the same wealth level for decades, even when they're genuinely trying to do the right thing with money. If you're someone who has some savings, maybe even a decent salary, but you feel like that big number, 1 crore, is always just slightly out of reach, like it's a goal for other people, richer people, luckier people, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Because today, I'm going to show you the actual math, the stuff nobody puts on a whiteboard in school behind going from 10 lakh rupees to 1 crore rupees. And more importantly, I'm going to show you why most people never get there, even though the path is genuinely not that complicated. Let's get into it. Okay, back to that FD story. Your 10 lakh rupees sits in a fixed deposit, HDFC, SBI, wherever. As of March 2026, you're getting roughly 6 to 7% per annum on a typical 1 to 2 year FD. Fine, sounds reasonable, right? But here's the thing, you're not in the 10% tax bracket. If you're earning a decent salary, let's say you're in the 30% bracket, that 7% just became 4.9% post-tax. That's how tax math works on FD interest. It gets added to your income and taxed as income, not as capital gains, as income. Now, India's retail inflation, as tracked by the Consumer Price Index, the RBI's own comfort zone is 2 to 6%, with a medium-term target of 4%. But here's what you actually experience as a person living in an Indian city in 2026. Education costs running at 8 to 12% annual inflation, healthcare running well above CPI averages. Your actual personal inflation is almost certainly above 5%. So do the math with me. 7% FD return, 4.9% post-tax, minus 5% inflation equals negative 0.1% real return. You're working every single month, sacrificing consumption, carefully putting money aside, and your purchasing power is going backward, very slowly, very quietly, but backward. And here's the stat that makes me want to flip a table. That 1 lakh rupees you had in 2006, in 2026 you need 3.2 to 3.6 lakh rupees to buy the same things. Meaning, if you'd kept that 1 lakh rupees in an FD for 20 years, you'd have roughly 3.9 lakh rupees today. Sounds like you won, right? You barely broke even in real terms after 2 decades. This is the FD trap, and almost every middle-class Indian family is sitting inside it right now, feeling safe. Now let me give you some numbers that genuinely surprised me when I dug into them. India's mutual fund industry crossed 81 lakh crore rupees in assets under management by November 2025. That's insane growth. The industry grew 21% in a single year. Source: Amphi Franklin Templeton India Annual Outlook 2026. SIP inflows hit a record 31,002 crore rupees in December 2025 alone, per month. That's crores of Indians putting money in every single month through systematic investment plans. And yet, and this is the part that gets me, only 4 to 7% of Indian households are invested in mutual funds. And even the most generous SEBI and Bain estimates put it well below 10%. In the United States, 37% of the population is in mutual funds. We have an 81 lakh crore rupees industry being run by a tiny sliver of a 140 crore country. That means 90+% of India, including probably most people watching this right now, is either not investing, investing incorrectly, or parking money in instruments that are quietly destroying their purchasing power. There are currently over 21 crore Demat accounts in India as of early 2026. Growing fast, yes, but still just a fraction of who should be participating. The opportunity here is massive, and the people who figure this math early are the ones who end up with crores. The ones who don't, well, they end up with a story about how the markets are risky and FDs are safe. Alright, this is the section I made the entire video for. Let's talk numbers. Your goal: turn 10 lakh rupees into 1 crore rupees. That's a 10 times multiplication. Sounds massive. Sounds like it requires a miracle or insider trading or being born into the right family. It doesn't. It requires time and rate of return. That's it. Those two variables determine everything. Let me show you the difference between a 7% world and a 12% world. At 7% annual returns, classic FD debt fund territory, 10 lakh rupees doubles in roughly 10.3 years. Rule of 72. Divide 72 by your interest rate. To become 1 crore rupees from 10 lakh rupees, you need roughly 33 to 34 years. 33 years. If you're 30 today, you hit your crore at 63. Just in time to retire maybe. Hopefully your health is cooperating. At 12% annual returns, long-term equity mutual fund territory, 10 lakh rupees doubles in 6 years. At 12%, your 10 lakh rupees becomes 1 crore rupees in approximately 20 years. 20 years instead of 33. 13 years of your life saved just by choosing a different vehicle. Now here's where it gets really interesting. What if instead of just sitting on 10 lakh rupees, you added to it? What if you ran a SIP alongside that lump sum? Let's say you put your 10 lakh rupees into a diversified equity mutual fund at 12% CAGR, and you also start a monthly SIP of just 10,000 rupees. That's 10,000 rupees a month. For a lot of viewers, that's totally doable. After 15 years, your 10 lakh rupees lump sum has grown to approximately 54.7 lakh rupees. Your 10,000 rupees a month SIP has compounded to approximately 50.4 lakh rupees. Combined, roughly 1.05 crore rupees. 15 years with a combination of your existing savings and a discipline of 333 rupees per day. I'll say that again. 333 rupees per day, the cost of 2 decent chai and snack combos at a cafe, invested consistently, combined with your 10 lakh rupees starting corpus, gets you to a crore in 15 years at market average returns. Quick caveat, important. Now, two things I want to flag right here so the comments don't fill up. One, when you withdraw, you will pay long-term capital gains tax of 12.5% on gains above 1,25,000 rupees per year. But even after that haircut, equity absolutely crushes the FD over 15 years. We are talking post-tax equity returns still likely double what an FD delivers in real terms. 2. Past 15-year rolling returns for Nifty 50 and diversified funds have historically delivered 12 to 14% CAGR. Future results will vary. I use 12% as a conservative assumption in this video, not a promise. Now you might be thinking, Rohan, 12%? Is that realistic? Can equity really do that? Fair question. Let me answer it directly. The Nifty 50 has delivered roughly 12 to 14% CAGR over rolling 15-year periods historically. FlexiCap and diversified equity funds have matched or slightly beaten this. Is this guaranteed? No. Markets go up, markets crash. 2020 happened, 2022 happened. But over 15-year rolling periods, the data is consistent. And here's something AMFI's own projections say. Equity-linked SIPs have historically delivered 10 to 12% over the long term, comfortably outpacing the near zero or negative real returns from FDs after inflation and taxes. So the question isn't whether equity is risky. The real question is, what's the risk of not being in equity when your alternative is a guaranteed real return of negative 0.1%? Here's what most people don't realize. The math is the easy part. I can sit here and show you spreadsheets and CAGR calculations all day. You can nod along, feel inspired, open a Zerodha or Grow account, set up a 5,000 rupee SIB, and then when the market drops 15% in October, you cancel it. And that's the move that keeps people poor. Not the ignorance of the math, the psychology of discomfort. See, your brain has what psychologists call loss aversion. Losing 50,000 rupees feels roughly twice as painful as gaining 50,000 rupees feels good. It's wired in. It kept your ancestors alive on the savannah. It is absolutely destroying your portfolio in 2026. When markets fall, and they will fall, your FD-trained brain screams, see, this is risky, get out, protect what you have. And you redeem, you exit, you lock in the loss, and you go back to the FD. And you repeat this cycle every 3 to 5 years and then wonder why you're 45 with 40 lakh rupees when you've been investing for 15 years. I've seen this pattern so many times, yaar. It's painful to watch. Stop thinking about your investment portfolio as money. Start thinking about it as a machine. Your SIP is a machine that runs every month whether you look at it or not. A market crash doesn't break the machine. It actually feeds it cheaper units. That's rupee cost averaging. When the NAV drops, your 10,000 rupees buys more units, which means when recovery happens, you gain more. The investors who built crores in India didn't avoid market crashes. They ignored market crashes. They kept the SIP running through COVID lows, through 2022 corrections, through every panic headline. The machine kept running. Okay, now I want to show you something that most financial content completely ignores and is probably the single biggest accelerant to your 10 lakh rupees to 1 crore rupees journey. It's called the SIP Step Up, or in some apps, the SIP Top Up. The idea is simple. Every year, you increase your SIP amount by a fixed percentage, say 10% annually. To be crystal clear, you don't need to find another 10 lakh rupees. You just increase your 10,000 rupees monthly SIP by 10% next year. That's it. Year 1, you pay 10,000 rupees a month. Year 2, you pay 11,000 rupees a month. The lump sum sits and compounds untouched. Why 10%? Because if you're on a decent career trajectory, your salary should be growing by at least that much anyway. Your increment, your variable pay, your side income, it goes somewhere. Most people let it flow into lifestyle inflation. New phone, bigger flat, eating out more. And that's fine, enjoy your life. But some of that increment should flow into your investment machine. Let's revisit our earlier example with the step up. Start 10 lakh rupees lump sum plus 10,000 rupees SIP, add 10% annual SIP step up. After 12 years at 12% CAGR, you're looking at approximately 90 lakh rupees, nearing your crore. You shaved 3 more years of the timeline just by incrementing your SIP once a year. And here's the beautiful thing. In year 1, you're adding 10,000 rupees a month. By year 5, it's 14,641 rupees a month. By year 10, it's 23,759 rupees a month. These aren't painful jumps. They're proportional to what you're likely earning by then anyway. You just have to make the commitment now when the discipline is forming. Look, I want to make sure this video isn't just theoretical. Let me ground this in what's actually happening in India's markets in early 2026. Equity mutual fund inflows were up 8% month-on-month in February 2026, reaching 25,978 crore rupees according to AMFI data. And this is happening despite some market volatility from global geopolitical factors. Smart retail investors are not running away, they're adding. The RBI's repo rate sits at 5.25% as of early 2026, with further cuts likely later in the year. This means FD rates will keep drifting lower. The era of comfortable 7.5% FDs probably ending. Banks are already trimming. Meanwhile, India's GDP is growing at about 7.4%. Corporate earnings are expanding. The same businesses you interact with daily, your telecom provider, your banking app, the platform you ordered food from last night, are publicly listed companies. Your SIP in a Nifty 50 indexed fund means you own a tiny piece of all of them. Here's a reframe I want to leave you with. An FD is a loan you give to a bank. An equity mutual fund is a business you part own. One pays you interest, the other pays you a share of profits and growth. Over 15 to 20 years, which do you think wins? Before I give you the action steps, let me be really direct about the things that will blow up your 10 lakh rupees to 1 crore rupees plan. Mistake 1. Stopping your SIP when markets fall. I already talked about this. Don't do it. The machine must keep running. Mistake 2. Chasing sectoral or thematic funds early on. You don't need a defense sector fund or a global AI technology fund when you're building your first crore. These are fine for experienced investors with diversified portfolios. For you right now, a simple flexi cap or Nifty 50 index fund, that's it. Mistake 3. Thinking you'll time the market. You won't. Nobody does. Consistently. Not even the professionals. The data on this is brutally clear. The cost of missing just the 10 best trading days in a 20-year period cuts your returns almost in half, and those best days almost always happen during the scariest weeks. Stay invested. Mistake 4. Ignoring the emergency fund. Here's what most people don't realize. The reason people break their SIPs is often not psychology. It's cash flow crisis, car repair, medical expense, job transition. If you don't have 4 to 6 months of expenses in a liquid fund or high-yield savings account before you start your 10 lakh rupees investment journey, you'll be forced to redeem at exactly the wrong time. Build the emergency buffer first. Mistake 5. Treating your goal as 1 crore rupees instead of financial freedom. This one's subtle but important. 1 crore rupees in 2026 is not what 1 crore rupees was in 2006. By the time you hit your crore in 2041, inflation will have made it worth significantly less in real terms. The goal isn't a number. The goal is a corpus that generates enough passive income to cover your lifestyle. Keep your eye on that, not just a headline figure. Okay, I know this has been a lot. Let me give you a clear, clean action plan. 5 steps, do them in order. Step 1. Build your emergency fund first. 4 to 6 months of monthly expenses in a liquid mutual fund or high-yield savings account. Non-negotiable. Touch nothing until this is done. Step 2. Deploy your 10 lakh rupees strategically. Don't dump it all in one go if markets feel volatile. Use a systematic transfer plan. Park it in a liquid fund and transfer 80,000 to 1 lakh rupees per month into an equity fund over 10 to 12 months. You get the benefit of rupee cost averaging on your lump sum. Step 3. Start a monthly SIP immediately. Even 5,000 rupees is fine to start. Pick one fund, a Nifty 50 indexed fund or a top-rated flexi-cap fund. Set it on auto-debit so you never have to decide to invest each month. Step 4. Commit to a 10% annual step-up. When your January increment comes, increase your SIP by 10%. Put it on the calendar. Make it automatic if your fund house allows it. Most do now through apps like Coin, Grow, or Paytm Money. Step 5. Do not look at your portfolio more than once a quarter. I mean it. Remove the app from your home screen if you have to. More checking equals more emotional decisions equals worse returns. This is one of the most evidence-based findings in behavioral finance. Quarterly reviews, maximum. Look, I want to be real with you for a second. The math of going from 10 lakh rupees to 1 crore rupees is not complicated. It never was. 15 to 20 years, a 12% average return, consistent SIP, annual step-up, some patience, some discipline during the scary months. That's the formula. It fits in one paragraph. The reason more people don't do it isn't lack of information, it's lack of conviction. Because the FT feels safe and the market feels like a casino. Because your uncle had a bad experience in 2008 and hasn't touched stocks since. Because every market crash is covered with doom headlines and every bull run is covered with "Is this a bubble?" warning. Here's what I want you to hold on to. India's mutual fund industry is heading towards 2,791 lakh crore rupees in 2047 according to AMFI's own projections. The equity culture in this country is just beginning. You have the opportunity to be on the right side of one of the greatest wealth creation cycles in human history in the fastest growing large economy on the planet, with a compounding machine running in your pocket. The only thing standing between you and 1 crore rupees is not luck, not connections, not a 6-figure salary. It's this, starting today, with the math they didn't teach you in school. Now you know it. So what are you waiting for? If this video helped you out, drop a like. It genuinely helps reach more people who need to hear this. I'll see you there.